Good day, people. Scott Hensey here from Avalanche Enterprise, and welcome to another round of Entrepreneur Bites. So basically, I just finished reading this book called Rich Dad, Poor Dad by Robert Kiyosaki. Just a little bit of general information about him. Robert Kiyosaki is a personal best author seller. He's written the book Rich Dad, Poor Dad, and what he talks about in it is financial education and the power of financial education. So when he was growing up, he had a rich dad and a poor dad. And basically, his poor dad was his real dad, and his rich dad was a friend's dad. And what he talks about is how different people's mindsets, so a poor person's mindset and a rich person's mindset, are completely different. So what he goes on to say is that, poor people's mindset is focused, majority around having job satisfaction and stability. There's a big emphasis on playing it safe and not, grasping on opportunities that come people's way. But rich dad, on the other hand, focuses all his efforts on learning, continuous improvement, going out there and finding opportunities that can arise and capitalizing on them, because a lot of people are poor in this world because they just don't see what's in front of them. 90% of things or opportunities that you see come in your mind, not with your eyes. So it's really important to start, looking out there for opportunities, because they do come. Opportunities come and go every single day. And the only difference that it makes is how your application is, focused towards it. So what I'm going to do today is just talk a little bit about the main things that he talks about to do with financial intelligence and how that's actually impacted us here at Avalanche Enterprise in terms of investing in the stock market. So if I just put financial intelligence here. So there you have financial intelligence. So when you're at school, I bet you any money that you did not learn anything about financial intelligence. When you were at school, did people tell you, or your teachers tell you, how to apply for credit cards? Did people tell you how to read a balance sheet? Did people tell you anything about, debt, equity, assets? Unless you did an accounting module or you specialized something along those lines, you wouldn't have heard of anything. And it's a real joke, to be honest, because this education system today is just based on, subjects and nothing like history, arts, politics, whatever, but, nothing to do with financial intelligence. And it's really concerning that in today's day and age of, innovation and financial innovation, and, a lot more people today are in debt, a lot more people today are just not realizing their goals and dreams because they don't have this financial intelligence. And what Robert Kiyosaki talks about in this book is basically about financial intelligence, how you can capitalize on learning and growing and improving to bring financial rewards and benefits. So the first thing he talks about, if you want to gain a more, financial intelligent mind, is accounting. Now, accounting is really important because it's the ability to interpret numbers and the ability to see where numbers are coming in and out. So, for example, if we're looking at a company's balance sheet, it's really important to know what their assets are, what their liabilities are, and what equity is. Because a balance sheet is just a snapshot of time of a business. So if you can't understand the numbers that are coming in, how are you supposed to value a business? And one of the main reasons why some of these top hedge fund managers and fund managers are so rich is because they have an intricate ability to read numbers. It's like a second language to them. So accounting is so important if you want to be able to value businesses, find out if something's undervalued, and obviously if it's undervalued, then it should be bought into potentially. So that's accounting. The next one you got there is investing. So in his book, he talks about how poor people just focus on stability. They focus on job security. They don't want to take risks in life. They don't want to go out there and grasp on opportunities. They don't want to, learn. They don't want to capitalize on what's in front of them. In today's day and age, you've got such a big, wealth of information available on the internet, in books, and people are just, those poor people don't really capitalize on that. So investing is hugely important when it comes to getting rich or financially intelligent, because investing is all about making money with money. So you grow in your money using other people's money or your own money. And that's when the compound effect can kick in, and that's when you can realize huge amounts of money if you pick the right stocks and stuff. So it's just having that ability to be able to, fight, to be able to see what's a good investment and what's a bad investment. And I've never met a rich person that hasn't made a bad investment mistake. I've never met, people who haven't made mistakes in their life and then gone on to where they have in the position that they are today. That's why failure is so important, and failure is the main reason why so many people are successful. People suffer knockbacks, suffer from, disappointments, but it's not how bad that failure is, it's about how hard you bounce back from that. I would say that I've had a couple of failures myself in life, that I determine my own personal failures, but as a result of those failures, I've become the person I am today. I would never ever be in this position I am in today unless I failed. So failure is absolutely critical when, trying to become a better person, and just a better person at your job as well. Failure is absolutely critical. But it's also a lot to do with risk-taking. And I think this comes from a personal standpoint. You're either a risk-taker or you're a safe, guarded person. And the people who take risks are the people that are going to be successful in life. You have to take risks if you want to realize your dreams and your goals. And that says a lot about a person, If you can't muster the ability to take risks or take a chance or explore the unexplored, you are not going to get any further in your life. You are always going to be remaining at this level. So for instance, if someone wants to play it safe, don't think investing is right for them, they don't want to risk their money, their life is going to be like this. It's going to be average, and it's going to keep going and going and going. For someone who wants to take risk and is risk tolerant, then their life is going to go like this. So there'll be some dips. Of course there'll be some dips. You're not going to be successful 100% of the time investing. But you dip, up, dip, up, dip, up. And over the years and over compounding, you're going to become a much better person as a result of the knowledge you've acquired, and also with the fat stacks in your bank. So it's a lot to do, it's all to do with risk-taking and understanding value. Okay, so the third thing he talks about in his book is understanding markets. I'm just going to put UN there because I can't be bothered to write that. Understanding markets, so understanding supply and demand, understanding what people want, and understanding how you're going to deliver that product to them. So here at Avalanche, we know that there's a huge need for management consultants or people who need to get their brand or product out there. So there's a demand for lead generation and a demand for qualified leads. And that's what we do here at Avalanche. We primarily focus on business-to-business lead generation, and we've produced fantastic results for a huge range of clients. So that's supply and demand in marketing terms. We know that there's demand for our services, so we supply. And it's about the quality of that service and the quality of that delivery that makes us who we are. The best in the UK, I believe. So understanding the markets in terms of stocks is hugely important too. For instance, Avalanche as a group, we're invested in the pharmaceutical industry. We know that there's demand for drugs because People's lives are increasing. There's more people being born every day. And the need for drugs and the demand for drugs is soaring. And these pharmaceutical companies are the ones supplying. So it would make perfect investment sense if we're investing in pharmaceutical companies because there's going to be exogenous demand. We know there's going to be huge demand for the future, 30, 40, 50, 60 years' time. So we consider that fundamentally, one fundamental aspect of investing, very, very important. And that's why we have chosen the pharma industry to start our kind of, investment strategy sort of thing. So understanding markets, very, very, very important. And lastly, but not least, understanding the law. And I'm going to put 2 huge stars there. It's all good, it's all well and good doing everything you're doing in stocks. It's all good doing all your business processes and systems and everything to do with business, but it is hugely, hugely important, I can't stress this enough, that you have to abide by the law. If we take Mr. Jordan Belfort, for example, he ran a fantastic investment company, Stratton Oakmont, hugely successful, made hundreds and hundreds of millions of dollars, but did he stick to the law? Nope. Did he go to prison? Yeah. So it doesn't matter how successful your company is, it doesn't matter how you get your company there, you have to stick to the law because otherwise it's going to come back and bite you on your ass, which nobody wants. So that's what Robert Kiyosaki basically talks about, is investing, accounting, understanding law, and understanding the markets. Hugely, hugely important to increase your financial intelligence and ultimately increase the numbers in your bank. And I just want to read out a couple of paragraphs from the book because I think they're very, very important in terms of what we're doing today with our pharmaceutical stocks. So let me just rub this off a second. Okay, so the first chapter I will read. Okay, so I'm just going to read out the 2 chapters and then I'll do some commentary after it. So he says, safe people or safe investors go to their financial planners or accountants or stockbrokers and buy a balanced portfolio. Most have lots of cash in CDs, credit defaults, low yield bonds, mutual funds, and that can be traded within a mutual fund family and a few individual stocks. It is a safe and sensible portfolio, but it is not a winning portfolio. It is a portfolio of someone playing not to lose. Don't get me wrong, it's probably a better portfolio than more than 70% of the population has, and that's frightening. It's a great portfolio for someone who loves safety. Playing it safe and balanced on your investment portfolio is not the way successful investors play the game. If you have little money and you want to be rich, you must first be focused, not balanced. If you look at any successful person, at the start they were not balanced. Balanced people go nowhere. They stay in one spot. To make progress, you must first go unbalanced, just like how you make progress walking. So when you're a toddler, you attempt to walk, you fall down. You attempt to walk, you fall down. And then one day, you're balanced and you can walk. So it's a continuous process. Thomas Edison was not balanced, he was focused. Bill Gates was not balanced, he was focused. Donald Trump is focused, Bill Ackman is focused, George Soros is focused. So what he's trying to say here, and what makes sense here, is, if you want to be rich, you must have that desire to be focused. You look at Pershing Square today, Bill Ackman's closed-end hedge fund. They make a series of concentrated investments. I think they have 11 at the moment. 11 investments, and that's it. Just 11. You got other mutual funds, you got other hedge funds, got 50, 60, 70, up to 100 investments. But because of focusing and doing due diligence in huge amounts of quality and, sitting for hours at that board table with his team, with Ryan and all the rest of them, he's been able to choose 11 investments that make solid business and investment sense. And that's why he is so successful, because these concentrated investments have brought returns time and time again. Okay, with the exception of Valiant last couple of years, without that, the firm has performed absolutely outstanding. They beat the S&P 500 in 2014 by 20%, I think. So incredible numbers. So what Robert Kiyosaki here is saying, put a lot of eggs in a few baskets and focus. It's all about focus. If you focus on something and compound your efforts towards that focus, you will be successful. So that's just a little paragraph from him there. And the second one, before I do some commentary on the industry we're in at the moment, most people are poor when it comes to investing. The world is filled with chicken littles running around, yelling, "The sky is falling, the sky is falling." And chicken littles are effective because every one of us is a little chicken. It often takes great courage to not let rumours and talk of doom and gloom affect your doubts and fears. But as a savvy investor knows, but the seemingly worst of times is actually the best times to make money. When everyone else is too afraid to act, they pull the trigger and get rewarded. So what I talk about here is, let me just show you this. At the moment, we're invested in a biotech small cap stock called PTX. You've probably seen a couple of videos at our live valuation with Josh and a couple of videos before, so if you want to go see those, check them out. But PTX is an undervalued biotech stock that we are invested in at the moment. And it's trading at, I think it's $4.20 or whatever. So because it's trading so low, because the main reason why it's trading so low is because of the debt. People don't think the debt can be serviced. They've said in 8Ks and 10Ks that debt is an actual big risk, and the company has a real possibility of going bankrupt by the 31st of July if the debt is not paid. But what people don't, the people holding these shares long, so holding those shares, anticipating a return. These people are holding these shares based on their fundamental analysis, based on their financial analysis, and by having that risk sort of factor inside them. Now, the funny thing is, you get a lot of people who might short the stock. So they borrow the shares from the broker, sell them, wait for the short price to drop, buy back in, keep the money. These people are speculators, and the number one rule of investing: never, ever, 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 ever trade on speculation, because it's all bullshit. Let me give you a big example here. Stock twits. Now, I love stock twits, and the team loves stock twits. We use it for good reason. We go on there, we chat with the community, we gauge ideas, we try and gain insight and perspectives, and there's a lot of people on there that do share some quality articles and quality information that are really, really important to the investor who wants to buy. It's a really good, forum for activity. It's good to, it's just really good to really gauge everyone, like I said, and try and piece together what kind of instruments make up the investment. And one thing I will say is that we never, ever, ever base our investing ideas on stock twits. We merely use it as a platform just to gauge what the investment community is feeling. But on stock twits, there's a lot of people who post every day saying PTX is a terrible company, PTX is a piece of shit, PTX is going to go bust, you're going to lose your money. And unfortunately for some people listen to them. And it's crazy because people are bashing the stock and they get personal with attacks. And it's all speculation. So what I would say there is you just don't listen to those people. If your due diligence is correct, if your fundamental analysis and financial analysis is on point, you're not gonna. Of course, you could lose money. Of course, you can, but you are more likely to win rather than lose. So that's why you should never ever listen to speculation. And as Warren Buffett says, you know, Warren Buffett says, never ever trade on speculation. And when I come back to a point on Robert's book, let me just find it one sec. Playing it safe is unbalanced on your investment portfolio is not the way successful investors play the game. And it's not. If you want those high risk, high return stocks, you've got to go for the low cap stocks. You've got to go for stocks that are vulnerable. You've got to go for stocks that have a lot of baggage held to them. But what you do, as a savvy investor, you find that little speck of gold in a stock and you capitalize on it by putting your money where your mouth is and saying, yes, I'm invested in the stock for these reasons, A, B, C, and D, and that's why I think the stock is going to go up. And that's what we've done with PTX. You know, we know that the management has got vast amounts of experience in M&A. Graham Lang, you've got John Cedar, was a huge pharmaceutical veteran, 30 years plus experience. You know that their drugs are profitable. You know that sales are increasing, the EBITDA is increased. You know, the debt is not really an issue because it's going to be refinanced by the 31st of July. So very interesting to see what happens there. And we just know that these drugs, as I said, coming back to supply and demand, these drugs are in demand. You know, Tylenol has got the potential to go over the counter, huge, $1 billion, you know, stateside kind of market. You've got Trexamit, you've got Zohydro, who has had 11% year-on-year increases and has just become an industry-focused drug as a result of the article that was written the other day by, I don't know who it was actually, but 5 companies, including Teva, are going to be sued because of their addictive painkillers are causing a huge, you know, wave of addiction across America. So as an investor, you look at that and you think, well, if companies are going to be, you know, sued for these drugs, you know, from patients to doctors to pushing it on to patients, then they're going to go for an alternative. And Zohydro is a non-addictive drug that has, you know, no addiction. It's a safe drug and it's much, much better than the market competitors at the moment. So I expect PTX share price to rise because, you know, there'll be natural demand for this drug now, and it all just adds up to a good investment in my eyes. So that's basically what Robert Kiyosaki talks about safe investments. Don't make safe investments if you want the big rewards. Go for the penny stocks. Go for those stocks that hold substantial value, and, you know, just go for things that you feel right. It's weird because I've looked at hundreds of stocks, and, you know, I read the balance sheets, I read about the company's management, I read about everything I can to do with them before choosing an investment. And sometimes I look at stocks for 20 minutes and I think, nah, not for me. Look at another one, might take 40 minutes. It's a little bit better than the last one, but no. And then you'll finally find a stock, and you'll know you find it's right because in your heart you'll know it's right, and in your head you'll know it's right, because something just sits in you that thinks, yeah, A plus B plus C plus D equals buy. And, you know, it's about aligning those kind of areas so they all meet up, and then the buy comes at the end. And that's what happened with PTX. I've been following PTX now for a year, and, you know, I've seen the ups and downs, and I've seen ups and then downs and downs and then ups. But I know fundamentally that company is substantially undervalued, and we know at Avalanche that it's going to return at least 7, 8, 9x. I'm not FCA approved, I can't give out financial information because I'm not qualified, but this is just my opinion and the opinion of everyone here at Avalanche. So I hope you enjoyed that. It went on a bit longer than expected, but it's all good because, you know, at the end of the day, I absolutely love investing. It's my main passion. It's something that I'm definitely going to be a part of for the rest of my life, 60, 70 years. In 3-4 years, I want to open my own hedge fund. And, you know, everything I'm doing at the moment is just about equipping myself for that. So at any opportunity I want to learn, any opportunity I want to read a book, any opportunity I want to watch videos and engage with people through Avalanche, it's all going to be good stuff in the end. So thank you very, very much for watching. Give us a like, a thumbs up and subscription, and I shall see you for another Entrepreneur Bite next week. Thanks, guys.